Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, September 6th, 5:35 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are in a correction. You can see over here in the upper right by the trend gauge, all three time frames that we track the five major indexes against are all in bearish slash downtrend mode, meaning that they are trending beneath the short-term 21-day exponential moving average, the medium-term 50-day moving average, and the long-term 200-day moving average. Leaders, we still have set as neutral. They're still holding up okay. Pockets of strength, not something you'd want to get overly involved with, but they haven't broken down to the point that there's absolutely nothing to even consider getting into if the markets were able to right themselves over a short period of time. So what happened today? Lower lows, but 3,900 holds. So a little bit of bad, a little bit of good. This key 3,900 area. I talked last week about how the longer you knock on it, the weaker it gets. And earlier this morning, about within an hour after the close, things were looking pretty bleak for the indexes, but we had a false breakdown under 3,900, reclaimed it quickly, and went on a decent run to the upside, made new highs of the day, but faded since then. Here are the overall numbers for the day. So our G6, this is our Revere 6 Growth ETF composite, down 0.8%. S&P opened green on the day. In fact, all the indexes did. They were more green overnight than they were at the open. They were fading into the open, but you can see the red finish here. That's typical of bear markets, is a green open and a red close. You see it all the time, and you certainly saw it again today. S&P 500 down 0.4, Nasdaq 100 down 0.7, Dow down 0.55, mid caps down 0.6, Russell down 1%. Global diversified 60/40 stock bond index down 0.63%. Our flagship GROTECTION portfolio down 0.22% on the day. We continue to lose less than the indexes. We have a 1,200 basis point or 12 percentage point lead over the S&P 500 this year. The S&P down 18%. We're down 6%. So we're going to be compounding from a much higher capital base than if we rode this ugly market the whole way down. Let's get into a little bit of the details about why we make those types of decisions here at Revere. And let's do it by taking a look at a chart of the S&P 500, and I'm going to describe for you how we do things. If you're familiar with it, familiar with us, you're familiar with this, but basically we look at a short-term moving average. That's the green line, 21-day exponential moving average. It's the sum of the last 21 days with extra weight given to the more recent days. The 50-day simple moving average and the 200-day simple moving averages are an intermediate term and long term. Those are industry standards that we pay attention to. A lot of algos and fund managers pay attention to them too. And when we're trending nicely above all three of these, we're as long in the market as we comfortably can be, with leading stocks and leading sectors, and taking part in the index uptrend. When things start turning sideways, our stops will start kicking in. We break below the short-term moving average, we'll take a little bit off the table. The medium-term moving average will back a little bit more off. If we really start accelerating to the downside, these moving averages will roll over and trend lower. And then if we break the black line, that's the 200-day moving average, we get extremely defensive with our client portfolios. And the reason for that is this chart right here. 13 bear markets. There's some brutal numbers on here. We all know the market trends up over the long term, but there are short and intermediate term time frames in there that can really be brutal to your portfolio, especially if you're approaching retirement. And our job here at Revere and how we market ourselves is the sleep at night factor. You won't ever get hit with the -50, -57, 58%. 2x4 to the back of the head like you got in the correction after the tech bubble burst and after the financial crisis. This is where we pride ourselves. Here's COVID down 35.4%. We were out in the low teens. January to July this year, our maximum down was 8% this year, not down 24.5%. We don't know if this is over. We could be starting the third leg down, but we do know that we'll be out of the way of it. You can see these severe bear market losses here, 6 of these 13, over 30% losses. That's an average of 44.5%. You need an 80% gain to get back to that. And if you're close to retirement, you just don't have time to do that. You plan your whole life to build your nest egg. The last thing that should happen is a negative sequence of returns take it away from you, and that's what we do here at Revere, is protect client assets to the downside and participate in market trends when they are going higher. That's simple. We can be under the 200-day moving average and start getting back in on a tactical basis that might turn into an intermediate term investment, which we're still working with the capital that we gained on this most recent run up. Once we got above the short-term 21-day back here off the bottom, we made a little bit on this bounce last week, sold it into this resistance at the moving average. Same rules we talk about on these videos all the time. We undercut and bounced again, a failed breakdown. We dipped another toe in the water today with that. We'll have a tight stop if it breaks below today's low. But basically, this is what we do, is manage money according to the trend of the market. And when risk is high, which is indicated by when we're below this black line, the 200-day moving average, we're extremely defensive with our clients' money. And if you're interested in this approach, give us a shout. You can email me, don@revereasset.com, or you can call 855-REAL-WEALTH. That's 855-732-5932. Revere President Danny Stewart will answer that, and he would be glad to talk to you about what we do here at Revere. So there's your S&P 500. As I said, let's take a look at this at a 5-minute chart here, and you can compare. Here's the 3,900 area. Well, let's get this out a little bit more. Let's go to a 15-minute chart. Here's the 3,900 area. You can see that it acted as support last Thursday, acted as support at the lows at the close on Friday. Monday was a holiday. Tuesday, at the beginning of the day, we undercut and reclaimed it. Undercut it just briefly again intraday, but didn't make new lows. So this 3,900, we took a 10% SSO position here on the undercut, reclaim, and then the back test of that 3,900 when we bounced in here. So it was in this area right around here that we bought 10%. So we're down less than a percent on this, like less than 0.5%. Bought it at around 39.20 was our entry area. So like I said, below today's low, we'll be strongly considering getting out of that and getting back to preserving capital. So that's what happened today. Undercut, reclaim. Really need to hold this 3,900 area, or we're headed down toward not much support in this area underneath that, all the way down to 36.37, which is where we bottomed in the middle of June. NASDAQ 100, similar action, a little bit weaker as it continues to be. You can see the relative strength line trending down. This is very typical. The NASDAQ 100 leads higher and it leads lower. And right now it's leading lower. This 290 area needs to hold. We broke the support of Thursday and Friday. You'll note that, and didn't get back above it. So more relative weakness in the NASDAQ 100 relative to the S&P 500. How about the Dow Jones Industrial Average? Also closed beneath the lows of Thursday and Friday. Mid caps, MDY, another close below, also below the lows of Thursday, Friday. IWM, small caps, also below the lows of Thursday, Friday. So the S&P 500, the only one of the major indexes that was able to get back inside of the lows by the close. That rhymes. I'm a poet and I didn't even know it. So that's what's going on with the indexes. Let's talk about some individual stocks. We got stopped out. Shockwave had a remaining little 1% position on that. Got a downgrade when it broke below the 21. We got out early in the morning, a little bit of a bounce. Got out right around, I think, where it closed. So it went lower, it came back a little bit, but now the 21 rolling over, that should act as resistance unless the market rights itself. Still definitely keeping our eye on Shockwave. The story is solid, and there's been very clear institutional accumulation in this since its earnings gap up. Also got stopped out on XOM. Oil's opened strong today, but then they faded. And we reached break even on the last half position, less than half position that we had in Exxon. So we stopped out on that. Didn't break the 21, but we don't like seeing green to red when we've held something. We are still holding LNG. This had a little bit of a spin out in the afternoon, but did close right on the 21-day exponential moving average. We're still profitable on this. We got into this back here when it broke out above the 150 area. And then I mentioned we took that SSO position on the undercut and reclaim of 3,900 today around the 3920 area. A couple other stocks, TBT. If this is going higher, interest rates are also going higher. That's not a good chart for bulls. Let's run through the tail of the tape quickly here. Put call elevated still at 1.14. VIX elevated at 26.91. Fear and greed continues to trickle lower in the fear range at a 41. We're operating under the bear case since 8/26 when Powell's speech killed the rally. A little bit of news over the weekend. Putin said Nord Stream pipeline gas to Europe is staying shut until the sanctions are lifted. And then to add insult to injury, OPEC cut production by 100,000 barrels a day, not helping the energy crisis over in Europe. They are looking at some. There's fear of a sovereign debt crisis over in Europe because of some of the extreme energy bills that businesses as well as individuals are seeing. Business can't pay its bills, its energy bills. It can't stay open. It can't make money. It can't pay the bank, and very serious potential for a very serious situation over there in Europe. Another note: pre-market. Market got weaker after this number came out. ISM services, actually this might have been after the open. Services PMI came out 50 above expectations, which means basically the economy is still expanding. That's not what the Fed wants to see. That means interest rates need to continue to go higher. So expectations coming in today were negative because we're under all the key moving averages. What we saw was lower lows, but 3,900 did hold, as you can see here. Support, undercut, and reclaim on the S&P, but broken on NASDAQ. I'll have this updated with the next support level down for tomorrow's tail of the tape. There's a choppy action for today. So some sectors, UUP, I already, let's take a look at that. UUP, man, so we broke out, we pulled back to the ADMA and now gap up and held that gap to the strong dollar is a serious headwinds for stocks. Hard to make any progress as long as that continues to stay strong. Solars were strong today. TAN, you can see that bounced off the 50-day moving average. Enphase was strong most of the day, undercut and reclaimed its 21-day moving average. Uranium stocks also strong today, URNM, as there continues to be talk about restarting nuclear plants all over the globe. In response to that, CCJ gapped up, but typical of how difficult this market is. This gapped up, got above 30, reversed, and gave all the gains back. So it went from a 6% gain to a 0.5% loss. That's what you get when you're dealing with a bear market. In most cases, strength is sold. We've been seeing that with some energy stocks lately too, which were the last couple of things that we were hanging on to, as well as Shockwave. Also, coal stocks strong, XME strong, and some defensive sectors, utilities, healthcare, and real estate strong. Oils started strong but reversed negative. Bonds strong all day, weak all day, as well as biotech, which finished down 2.85%. This was the one sector that led the leg up here a couple of weeks ago, given all those gains back down here, back to the 80 level. Below all the moving averages, got above the 200, the 21, and the 50, broke them all. So biotech, which was a shining star for a while, going from 78 to 95 up here in a couple of days, gave it all back. Talked about the changes that we made in the portfolio, selling Shockwave at Exxon, buying 10% SSO, bottom line for everything, lower lows. but 3,900 holds. Let's see what cards come out of the deck tomorrow. Let's see what other stocks we want to talk about right now. Some steel stocks are strong, and there may be some strength in U.S. steel stocks because some European steel companies are saying they've got to shut down because they can't afford the energy bills to run the plant. So Nucor undercut the 21, tried to get back above it today, closed right on it. Steel Dynamics, another one to keep an eye on, right under the 21, but they did close positive today. Oil stocks, for the most part, as I said, started strong, finished weak. Solar Array also looked good, bounced off the 21-day exponential moving average. So looking here at what the focus list coming into today was, let's go through the rest of those quickly. Lithium, LTHM, bounced off the 21-day exponential moving average. CCJ, I already covered that. Chipotle continues to be strong. With an undercut off of the bounce off the 1600 area and reclaiming the 21-day exponential moving average. I would own this if the market was better. CEG, Michael did some research on this today. We'll be talking about this on the podcast on Friday. They're a clear beneficiary of the Inflation Reduction Act, which funnels billions of dollars to clean energy. That chart just looks extremely strong considering the market. Oxy, not a good day today, along with the other oil stocks. First closed below the 21 since this big move up on and break out of the cup and handle on the when Buffett was given the approval to buy up to half of the company. And finally, FSLR, another strong solar stock, not giving anything back, continues to ride the 8 EMA higher. That's going to wrap it. As always, love to hear from you. Email us, don@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. We'll see if 3,900 can hold on again tomorrow. On the upside, the 4,000 level on the S&P is going to provide, actually it's 4020. The 50-day moving average has now flattened out. Not a good sign. Once you flatten out, the next sign is to roll over unless you can get back above it. So that's something we'll be watching. And that 4020 area, which was strong resistance on Friday when we tried to rally a little bit and then did a serious U-turn. See what happens if we get up to that area tomorrow. So wrapping up Tuesday, first trading day after the Labor Day holiday, and kind of the unofficial end of summer as far as Wall Street is concerned. Also the worst month from a seasonality standpoint of the 12 months for the stocks. We'll see if they can buck the trend or continue to get beaten down, since we have when we ran into this 200-day moving average back in the middle of August. So wrapping up Tuesday, 9/6, this is Don Vandenbord. Just the facts, telling it like it is. Thanks for listening. Remember, it's not how much you make, it's how much you keep. Have a great day.